and welcome to our channel where we help your real estate investments work harder for you. I'm Samantha from Elevate Realty in Toronto. In this video, I'm going to debunk 5 real estate investing myths that we frequently hear from new clients. Chances are you might have some of these misconceptions as well, so hang on tight and watch till the end. Now, without further ado, let's go into myth number 1. According to the book Rich Dad, Poor Dad, author Robert Kiyosaki tells his readers that a house is a liability. The theory is this: you're paying for the mortgage, utilities, taxes, maintenance, and repairs each month, so it's not actually your asset. It's not generating wealth for you, but you're creating more debt for yourself. Here's the thing: Toronto's seen steady annual appreciation of 8% over the past 10 years. When you combine higher returns with a lower cost of funds, it's actually a great investment. Let's look at an example where you purchased a property in 2015 for $600,000. With a 20% down payment and closing costs, the total capital required is around $138,000. Then you get a 5-year fixed mortgage at 2.5%, which means your monthly mortgage is around $1,900. Each month, on top of the mortgage, you also have to pay for utilities, property tax, insurance, maintenance, and repairs, so your total outgoing monthly cash flow is around $2,700. Now let's fast forward 5 years and you sell the property at market in 2020, this year, for around $880,000 based on actual 8% appreciation per year. So did you make money? Let's start by deducting everything you paid for. There's selling costs of around $3,500, all of the outgoing cash flow over the past 5 years of $185,000, and you also have to pay back the balance of the mortgage of around $423,000. We'll take out the initial capital of $138,000 as well, so that leaves you with a tax-free net gain of almost $105,000. You can also interpret this as a return of investment of 76%, plus you got to live there rent-free for 5 years. So if you qualify for a good mortgage and can afford to pay for the down payment and monthly expenses, then buying a house is an appreciating asset and not a net liability. Myth number 2. I have to pay capital gains tax when I rent out the basement of my house. First of all, I have to say that I'm not a tax professional, so please consult your accountant to verify this information. Okay, now when you rent out a property, it's considered a business, so technically you should be paying taxes on it. At the same time, there is a capital gains exemption if you sell your principal residence in Canada. So which one is it? Based on our discussions with our accountants, the general consensus is that the capital gains exemption can apply as long as the primary use of the property is your home and the basement suite is secondary. The CRA website gives more color here and tells us that a rental suite needs to meet these 3 conditions to be considered part of your principal residence. Number 1, your rental use is relatively small in relation to your principal residence. Now this is kind of vague here, but generally we think that it should be less than 50% of your total living space. Number 2, you did not make any structural changes to the property to make it more suitable for rental use. So basically, if you bought the property with a basement suite, then it's definitely okay. Number 3, you do not deduct any capital cost allowance. So when you deduct capital cost allowance, you're depreciating part of the rental unit to reduce your income taxes. And if you're doing this, you're telling the government that you intend to treat it like a business. So that's why the government says you should be paying taxes in this case. When you buy an investment property with a spouse, the capital gains can be split equally, right? Okay, so one of the reasons some couples might choose to do this is if one spouse makes a lot more than the other. By splitting the income and gains, they hope to lower their combined taxes. Again, not a tax professional here, but based on our accountant's advice, how things should be taxed really comes down to who contributed the money. So if the higher income earner is the one that's actually putting money into the investment property, then the income and capital gains should actually be allocated to that person. So if you really want to split income with your spouse, a better option is to create a spousal loan beforehand based on CRA's prescribed interest rates. How it works is that the higher income earner would lend the other spouse half of the capital required, and then both of you would invest together in the property. At the end of each year, the borrowing spouse would pay interest to the lending spouse, and this extra process effectively makes income splitting possible. Number 4, cash flow is king. Okay, cash flow is definitely important because you don't want to be stressing out about making mortgage payments on your investment property every month. But it shouldn't be the only thing you consider. There's actually 4 parts that contribute to real estate returns, and we think that it's important to put some weight on each of these 4 parts. The concept is similar to multiple streams of income. So if one income stream is affected, you still have 3 more income streams to fall back on. I dive into each of these 4 parts in this video right here. So if you want to learn more about it, you can head over to that video by hitting the link in the description below after you finish watching this one. Myth number 5, I can't qualify for another mortgage, so I can't buy a rental property. When you see this, we usually follow up with, did you check yet? And did you consult multiple banks? The reason why we ask this is because banks look at rental properties slightly differently compared to how they look at your primary residence. So just because you maxed out on your primary residence, it really doesn't mean you automatically don't qualify for another property. On top of this, each bank's approval process is also a bit different. Some banks use 50% of your rental income and others use all of your rental income to add to your total income. Some banks disregard operating expenses of rental properties, which reduces your total debt. Finally, other banks let you pull equity out of existing properties to pay for your new property's down payment, so this allows you to scale quicker. There's one more thing. Banks might also look at self-employed income, dividends from registered accounts, and foreign income differently. So what I'm saying is that there could be a better bank for you if you have a special situation. And if you don't know which bank to go to, our team can help. We're happy to schedule a free discovery call with you if you're looking to buy an investment property in Toronto. Basically, we'll look at your situation and then figure out which banks or brokers are best for you. I'll put a link in the description below so we can connect. All right, that's all from me for this week. I hope you learned something new, and if you did, please give this video a thumbs up, and don't forget to subscribe to our channel to see more weekly videos like this one. Finally, I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.